Hello and welcome to lesson number 8 of the Drafting Pleadings and Appearances. In this lesson, we will cover the topics of Pre-incorporation Contracts, MoA AoA, Underwriting Contracts, Shareholders Agreements, and Appointment of MD Manager CS. And along with this, we will also cover the concepts of Amalgamation Deeds, Slump Sale Agreements, Compromise Arrangements, and Settlements. As the name of the lesson suggests, it is drafting of agreements under the Companies Act. More or less, these topics have been covered in your executive and also in other papers of this professional program. And hence, I would not go much deep into the topics where I would only try to focus on the important ones and at the same time try to give you more tips on how to address the drafting issues under these topics. Coming to the pre-incorporation contracts. So what are pre-incorporation contracts? Pre-incorporation contracts are those contracts which have been entered into by a promoter before the incorporation. So as usual, let us try to understand it by way of an example. Let us say A and B. They want to start a company, AB Limited, AB Private Limited, let us say. Now, before incorporating a company, it's like, more or less all any promoter, they would invest in few things like, let us say, workspace, furniture. Just for the sake of simplicity, let us just take these two as the examples. So let us say he has taken a huge workspace for a capacity of 50 employees and the furniture as well. Now, do you think the promoter can enter into a contract in the name of a company which is yet to be incorporated? The answer is no, right? So it would be on his own name, right? So that is what is a pre-incorporation contract. Even though this contract has been entered for the purpose of the company, but still since the company is not in existence, you have no other go but to enter the contract on your personal name, correct? So that is a pre-incorporation contract or a preliminary contract. So you might ask me, then why are we interested? So what is the purpose of it? There is a purpose. The purpose is when you're drafting such contracts, you should ensure that you are giving reference to the company which is undergoing incorporation. You should in the contract clearly stipulate that he so and so person, Mr. A and Mr. B, are the promoters of the company AB Private Limited, which is to be incorporated, for which a name reservation has already been obtained from the register of companies. So you general practice is to apply for a name and reserve it and then apply for the registration, correct? So you can also mention the same fact saying that the registration, the name has been reserved and the company is to be incorporated. Why are we doing it? Because we are trying to say that this contract is for the company, because tomorrow once the company is incorporated, the promoter will take back the money from the company. The money which has invested in the company, he would take it back from the company, and hence this contract should give a mention that the company is not yet born or incorporated, and it would be incorporated in a due course of time. So that is what is called a pre-incorporation contracts, correct? Now, so pre-incorporation contracts is one. The next aspect is provisional contracts. So what are these provisional contracts? Provisional contracts are again those which have been entered after the incorporation but before the commencement of business. So the law says that unless you commence the business, you file a form for commencement of business, you can actually not start any commercial business activity, right? So even in that duration, when you actually want to purchase something, you cannot do it on the company's name. So you end up getting it done from the promoter itself, right? So even that is a pre-incorporation, I mean, that basically is a provisional contract, but yeah, so it is the next stage of a pre-incorporation contract. So before we go into that, let us just try to conclude the discussion on pre-incorporation contracts. So pre-incorporation contracts basically cannot be entered on the name of the company, and hence one thing you should clearly remember here is that post incorporation, that you should make sure that the company is adopting such pre-incorporation contracts. So this is very important in a pre-incorporation contract. Entering into pre-incorporation contract is one, but adopting a pre-incorporation contract is the most important thing. And what is this adopting? So once the private limited company is formed, then the private limited company, the promoters, and the third party with whom you have entered into a contract earlier, now they will enter into a tripartite agreement. So this tripartite agreement will help the promoter to take back the monies from the company, and also the liability will now be on the company and not on the personal liability of the promoter for payment of a maintenance of whatever be the reason. So the company per se will adopt the contract entered into by the promoter, which is the pre-incorporation contract, and then ratify all the acts which the promoter had already done, and further take the responsibility and the liabilities which the promoter had earlier agreed on the contract, which is the pre-incorporation contract. So this is the discussion on pre-incorporation contracts. Right? Now, let us very quickly go through this MoA and AoA. What do you draft in an MoA and AoA? So these are again the basics of the Companies Act which we have learnt. So MoA is the constitution of the company, whereas the AoA are the rules and regulations. So MoA is the external document, whereas AoA is the internal one within which regulates the company. So what does an MoA contain? Right, so MoA has, so when you're drafting an MoA, you should ensure that it contains the name of the company, full name of the company for which you have got the incorporation. So it should tally with the incorporation certificate, right? So after the name, it has to comprise of the state in which the registered office is situated. So this is very important, because when you shift the registered office, you basically go for alteration of MoA, because there's a change in the state. Unless there's a change in the state, you wouldn't go for alteration of an MoA, correct? Next, third clause would be your your object clause, as to what objects for which the company is being incorporated. So as per the Companies Act 2013, it is the objects and the ancillary objects, or rather the objects in furtherance of the main objects. That is what is the exact wording used. So name, state where the registered office is situated, objects clause. Then you have got your capital clause. So what is this capital clause? So capital clause is nothing but it comprises your authorized capital. So it contains what is the authorized capital of the company. So what is the relevance of the authorized capital? You pay stamp duty on the authorized capital, and authorized capital is the upper limit up to which you can raise any equity, or you can raise any you can allot any shares, right? So that is the relevance of it, and hence the MoA should clearly comprise what is the authorized capital. And then finally we have the liability clause. So liability clause defines whether you are limited by shares or limited by guarantee, or is it an unlimited company. So that is what is the liability clause. And finally we also have the subscription clause. So wherein the subscribers to the MoA agree to subscribe to so and so number of shares which they have agreed, which is put across their names. So this is predominantly a MoA. And talking about AoA, AoA contains everything which deals with the internal regulations of the company, which include the share capital, rights of the shareholders. This is very important, because we'll have a discussion on shareholders agreement where I'll also get back to you on the AoA part. Then we have the commissions, share certificates, calls, transfers, transmission, forfeiture, alteration, the procedure thereof, buyback, general meetings. In case of private companies, it makes a lot of sense, because in major provisions, or rather exemptions for the private limited companies, it is stated that unless otherwise stipulated in the articles of association, right? So which means if your articles state otherwise, then that would apply. If not, the one which is stated in the act would apply. So for those private limited companies which particularly want to claim such exemptions, then you as a draftsman, as a company secretary who would draft the articles, should carefully refer to what are all the exemptions which a private limited company can claim, just by way of altering, like having a different language in the AoA. So that would help you to better draft the articles of association in favor of your client, right? So, and along with this, a board, how the board meetings will be held, the KMP, these are all the things which an AoA can comprise of. But one thing which I want you to remember in an AoA, in the concept of AoA, is entrenchment. So what is entrenchment? Entrenchment is altering your articles to make it more stringent than what the law is stipulated. For example, law says your quorum requirement is 2. If you want the quorum to be 4, that is called as entrenchment of your articles. So entrenchment is encouraged because it is much more stringent implementation, and the law has got no objection for that. However, you have to carefully specify it, or as to what are all the entrenched clauses. So that is very important from the governance point of view. Usually it would happen in companies where there is large equity participation, and if they want control over the business operations and the decision making, and this is how they usually exercise that, right? Let's move forward. Underwriting agreements. So what is the concept of underwriters? So this also is something which we have studied in our executive. So underwriters are precisely the people who make sure that the issue is adequately subscribed. That is, the minimum subscription is in place. So as and when there is an issue being made, these people underwrite to ensure that all shares issued are taken up and thus the required capital is being raised. And what if people don't subscribe? These underwriters end up subscribing the unsubscribed portion. That is what is the role of an underwriter. So this is what will be precisely covered in an underwriter's agreement. So the underwriter's agreement will clearly cover two aspects. One, the consideration from the underwriters that they will ensure minimum subscription is in place, failing which they would subscribe to the portion, the balance portion, which is the deficit from the minimum subscription. So that is one clause which you mandatory should be covered in an underwriter's agreement. The second clause is the commission which they get, right? So as per the rule 13 of the prospectus and allotment securities rules 2014, the commission may be paid subject to the conditions, which are: one, it has to be authorized by the company's AoA. So as I told you earlier, the company's AoA should have prescribed for that. Second, it can be either out of the issue or out of the profit of the company or out of both. So you might give the commission out of your profits, or maybe out of the same issue from which you're raising money, you can end up giving them a portion of it as their commission, right? But can you give like unlimited commission to them? The answer is no. There is a restriction. So the restriction which they have prescribed is the 5% of the price at which shares are issued. So the number of applications we receive through the underwriter multiplied by the 5% of the price, it is what they get as their commission. But this is something which is the maximum. And when it comes to debentures, the commission is lesser, which is 2.5% of the issue price, right? So this is how the commission has also been restricted even under the Companies Act, right? And then the prospectus subject to which this public issue has been made shall disclose who the underwriters are, shall disclose the rate and the commission payable to such underwriter, shall also disclose the number of securities which is to be underwritten or subscribed by the underwriter absolutely or conditionally. So what are the number of securities which he has promised? Suppose if you have more than one underwriter, then they can distribute as to what is the maximum number of shares they would underwrite, right? So that is how this underwriting agreements pan out, right? And as part of the filing bar, this contract for the payment of commission, that is underwriter's contract, should also be delivered to the registrar. You should also file it with the ROC along with your prospectus, right? So this is what is an underwriter's commission, underwriter's agreement. Now coming to the main, the important concept, that is a shareholders agreement. So let us spend a fair bit of time on this. So what is a shareholders agreement, right? So why are we calling it a shareholders agreement? Is it an agreement between the company and the shareholders, or is it an agreement between the shareholders? So this is the first and the fundamental question which you should ask yourself. Who are the parties of this agreement? Correct? So in a shareholders agreement, always remember the parties are the shareholders only. So this is the agreement. It is not an agreement where company is one party and the shareholders are the other party. Never get confused that way. It is an agreement between two shareholders or maybe multiple shareholders, but where a company will also be a party. So company can be a consenting party, but company won't be the effective party, right? So it is the rights and liabilities of a shareholder or a group of shareholders will be decided by way of a shareholders agreement, right? So that's how the definition also pans out. It is a contractual arrangement between shareholders of a company, and which describes what? It describes how the company should be operated, and it also defines the inter se shareholders rights and obligations, right? So that is the basic funda behind the shareholders agreement. So now before I touch upon few aspects which are time and again tested in any examination in shareholders agreement, I would like to give some food for thought from my personal experience on drafting shareholders agreements and also on engaging in various negotiations before the drafting of shareholders agreement. So I'll try to make it a kind of a story for you people. So when an investor is ready to invest in a company, the first document they would enter is a term sheet, or it can at times be also an MoU. So this term sheet will usually, in 99% of the cases, will be non-binding. So what is this non-binding? So non-binding, by that it means any party at any point of time can just go back on this step. So what does this term sheet fundamentally set down? Is set down the various, it basically set down the very broad aspect of what the deal is all about. Suppose say I want to invest 1500 crores in OYO hotels, right? So, or rather, right, let me give you this example. Now, Flipkart is investing in Geo, or I think it, let us assume like the promoter RAL. Is purchasing shares from the promoter RAL, because of which it would end up getting approx 9% of its uh, stake in Geo. So what has happened here? One of the existing promoter as well as a shareholder of Geo has agreed to sell the stake to another shareholder, another prospective shareholder, which is Facebook. Now, if you look at carefully, what would have happened? Firstly, Facebook and Reliance Industries Limited would have entered into a term sheet wherein they stipulate various things as to what they will do. And after the term sheet, what happens would be major negotiations. There would be pre-negotiations, pre-term sheet negotiations as well, and even after the term sheet, there would be certain negotiations to finalize the deal. And once everything is finalized, what they fundamentally do is to they enter into a definitive agreement. This more or less covers what has all been agreed in a term sheet will be covering in a definitive agreement, and this will become binding. And alongside definitive agreement, when it is a kind of a deal where you are investing in equity, they would enter this. One of the definitive agreements will also include a shareholders agreement. So by definitive agreement, we mean an agreement which is conclusive. So a shareholders agreement is something which they would enter into along with a share purchase agreement. The share purchase agreement is basically purchasing. You give you it only covers that so and so money has been paid, so and so number of shares have been issued. That's all. That is a share purchase agreement. So under share purchase agreement, since it is a purchase with in the case which I have explained you, it is a purchase with the from the one of the existing shareholders, so it will be between both the shareholders. But where if you're actually investing in a company, then the company will be the main party in a share purchase agreement. However, when it comes to shareholders agreement, so here shareholders agreement, as I pointed out, it is an agreement between two parties, two shareholders. So in the case of Flipkart and Reliance Industries Limited, it is these two shareholders who have entered into a shareholders agreement, and Geo will be a party. Of course, it will be a party, but it is called as consenting party. Right? So what happens in a shareholders agreement? In a shareholders agreement will effectively cover what the transaction is all about, and then it ends up trying to establish certain issues like reserved matters. Let me just try to hit the nail. Reserved matters. So what does it say? Now Flipkart says, see Reliance Industries Limited, we know that you own Geo, but there are certain issues which you cannot discuss in your board unless our observer is present, or the board member whom we propose to be on the board of Geo to be present. And those issues are: 1. Finalizing of your financials; 2. Budget approvals; 3. Projections; 4. Company business plan, right? Business budget. So all these things, I want me to be present. Without my presence, you cannot decide on these aspects, and such items are called as reserved matters. So the shareholders agreement will contain a clause saying that second part, I mean, let's say Reliance Industries Limited cannot convene for a board meeting without the presence of so and so in the board, who is a representative of the Flipkart. So this is one. Second, it can also be like the Reliance Industries Limited cannot sell its shares to any other party. So now that Flipkart has come, what if Reliance Industries Limited also sells the shares to any opponent of, or rather any competitor of a Flipkart, right? So it is a threat to Flipkart. So what Flipkart effectively says is you cannot sell away your shares to any other party for a period of next, let us say 2 years, 3 years. They can freeze Reliance Industry from selling away its shares. Then will Reliance Industry agree to it? They may agree yes, or they might not. So what will Reliance Industry negotiate? It might say, okay, for the 1 year we agree, but for beyond 1 year, we would give you the first offer. If you reject our offer, then we should be given the freedom to go and sell it to any third party. So this can be one argument, right? So they, like that, there would be various terms which the shareholders agree among themselves for a comfortable business relationship. But can they mandate saying that the company cannot issue any further shares? The company cannot go for a rights issue. Can they do it? The answer is no. You cannot bind the company from doing something which the company can very well do it. So as a shareholders, as part of the shareholders agreement, you cannot restrict the company from doing something which its articles authorize it to do. Which means if you want the company to not do something, then you have to alter your articles of association. And how do you do it? By way of taking the approval from the shareholders. So that's why the shareholders agreement and articles of association will have a very close nexus. And when a question comes as to whether the shareholders agreement is valid or an articles of association is valid, the answer is always that the articles of association will prevail. The shareholders agreement cannot prevail over the articles of association, because shareholders agreement will not be the regulation of the company as the articles of association are, right? And coming to the enforceability of the shareholders agreements, there have been multiple orders in I mean rulings in this regard. However, the crux which we can see is that the shareholders agreement can never override the articles of association of a company, and hence any restriction not specified in the article shall not bind the company or the shareholders. So this is very important, and that is a very reason why immediately such private equity investors, not just in Geo deal, you can see any deal for that matter in Oyo rooms or in Ola or in Uber, wherever you see Amazon, whatever be the investments, wherever they invest, they would always alter the articles and try to include whatever has been agreed in the shareholders agreement. They want it to also to be part of the articles of association. So that is how a shareholders agreement will usually be drafted, right? So always remember, it is between the shareholders only, not between the company and the shareholders. However, the company will also be a party, and that is called as a consenting party, right? Let's move forward. Right, so now we will discuss as to what is the appointment, the contract of appointment of MD, contract of appointment of manager, and contract of appointment of a company secretary. So here I have a trick for you. So don't just think it is something which is, very unique agreements which we draft here. It is as good as a service contract. And if you remember, we had a fair discussion on how a service contract has to be drafted. So service contract is nothing but a contract between the employer and the employee, right? So it contains everything which a standard employment contract should contain. However, since these three authorities, that is the MD, manager, and company secretary, are getting their powers from the Companies Act, so a kind of a, you need to make sure that the contract also tries to cover the responsibilities which the statute gives to them. So that is something which you have to ensure, right? So for that, you also need to have a fair understanding of the definitions of these three terms, or the three offices, which is the MD, manager, and the company secretary. And from the definition, you get a lot of input, and your contract, apart from all other standard terms like office hours, remuneration, and remuneration is very important when it comes to the MD because he's also a director. apart from remuneration, office hours, office facilities, leave policy of the company, materiality, confidentiality, non-compete, these go without saying. That is part of the service contract. Apart from that, the definition of the MD will give you a lot of input. So that is the reason why I would only focus on the definition of the MD, manager, and CS for you to have an understanding. And apart from that, the contract with them is as good as a service contract between the employer and the employee. But this definition will give you a differential understanding. So let us see what is the definition of an MD. So the definition, you can find it from the code, but I've tried to split the definition in a way we can easily interpret. So first and the foremost, MD must be a director. So he should have been appointed as a director by the shareholders, or by as an additional director by the board. So your contract should mention the fact that he is a director, that he has been appointed as a director either by shareholders resolution or by a board of directors resolution. Make a mention of it. Also try to annex that resolution to the contract, right? Next, he shall be entrusted with substantial powers of management of the affairs of the company. So it has to be clearly stipulated in the contract that so and so person who is appointed as the managing director shall have the substantial powers of management of the affairs of the company as stated in the Companies Act 2013. Right? This term should comprise in your contract. And next, how can it be given? Now, this is very critical. See, he can be entrusted such powers by way of articles of the company. So your articles, if they contain that whoever be the MD shall be entrusted with the following powers, then by default, even if you do not mention anything in your contract, he would get those powers. So in such cases, the contract simply gives a reference to the articles of association and to the respective article if required, saying that all the powers as stipulated in the articles of association of the company shall be vested in so and so person who is hereby appointed as a managing director, right? And the act also says that it can also be by way of a agreement with the company, and this is what we are talking about here. So if your articles is silent on something, the agreement can also add on to it. And apart from that, your shareholders in their general body meeting can also give the powers and entrust such powers to the MD, or even by way of a board resolution when you are being appointed as an additional director and then subsequently as a managing director, then even then this would apply to you, right? So this is what a managing director effectively means, correct? So if you, to further understand as to what all clauses you would cover, as I repeat again, apart from the standard clauses in a service contract, you would cover the clauses that he is already a director, he shall have the powers which the articles stipulate, and can also actually quote various powers which he can exercise, right? And then the rest of the standard clauses will anyways be there, right? So this definition itself is something which gives you the inputs of an MD. Apart from that, it is a standard service contract. I repeat, I reiterate, but the only reason that, do not get panicked, do not think these three are some unique concepts. This is a proper service contract. Try to draft as a service contract and adding the flavor of what a managing director is all about. Now, directly hitting at the definition of the manager now. So, should a manager be a director? No, any individual can be a manager. And what does the manager have? MD has got he has been entrusted with the powers for the substantial affairs, right? The entire management. Whereas coming to the manager, he has got the management of the whole or substantially the whole of the affairs of a company. So there he has got the powers, whereas here he has got the management of the whole or substantially the whole. So the manager will always be subservient to the managing director. Next, and he is subject to the superintendent's control and direction of the board. So your service contract should clearly state that this manager shall report to the board directly. And in case of manager, and also I forgot to mention, even in the case of managing director, the remuneration part should be in compliance with the provisions of section 196, 197 and schedule 5 of the Companies Act 2013. So there shall be a clause which shall clearly state that the remuneration payable to the manager, or in the case of a managing director, to the managing director, shall be in compliance with the relevant provisions of the Companies Act 2013. And if you can remember, you can clearly state that shall be in compliance with the provisions of section 196, 197 and schedule 5. I personally do not recommend you to remember what the section is all about and try to recapitulate it in your contract. A simple reference saying that it shall be in compliance itself is sufficient, because whatever you state in your contract is nothing but a reproduction of what the section is all about. So it's always preferable to refer the section or even simply refer the act, and that would do the purpose, that would actually serve the purpose, right? So this is one important clause, remuneration. You cannot simply say you shall draw a salary of, like, of course you would specify what salary the managing director or the manager draws, but you should also stipulate a clause that it shall be in compliance with section 196, 197 and schedule 5. Now let us look into the company secretary. So company secretary, as defined under the Company Secretaries Act, and who is appointed by a company to perform the functions of a company secretary under the Act. It is of course a very confusing definition in the Companies Act. I agree. So it's predominantly the person who has been qualified as a company secretary and who has got a membership with the Institute of Company Secretaries of India. That is how the Company Secretaries Act has defined the company secretary, and who should have been appointed as a company secretary under the Companies Act. Because just by you being a company secretary and an employee of the company, you can never become the company secretary of the company. For you to become the company secretary of the company, you should have been appointed as a company secretary of the company. So I mean, this again, yeah, even I would have sounded so confusing, but the concept is a listed company, let us say A Limited is a listed company, it can have only one company secretary as per the Companies Act, whereas there might be some 15 company secretaries, let us say ACS, associate company secretaries, who are working with the company, but all the 15 are not company secretaries for the Companies Act. If you see Companies Act as a person, Companies Act will not see all these 15 guys as company secretaries. The Companies Act only views only one person as the company secretary who has been designated as such by the company. So there can be only one person who can be company secretary of a company, right? So getting the point? So remember that. So in terms of a contract of appointment of a company secretary, the terms usually are the same as for any service contract, and apart from that, it should stipulate that so and so person is a member of the Institute of Company Secretaries of India, the membership number, and that there are no disciplinary proceedings against such person. This is something which you can add. And apart from that, you should also clearly state that so and so person has been appointed as a company secretary of this company. That is very important. And what are the remuneration he draws, and then what are his responsibilities. The code has the Companies Act itself has stipulated certain responsibilities to the company secretaries, so that should clearly pan out in the contract. I mean, either you can give a reference to the section, or you can also try to specify what those responsibilities are. And such functions have been stipulated in section 205 of the Companies Act 2013, which include reporting to the board about the compliances, ensuring that the board company complies with the applicable secretarial standards, and also to discharge certain duties which which the central government prescribes from time to time. So this way the company secretary has got to do certain responsibilities, and it is preferable for the company secretary to ensure that all such compliances are in place. So usually the service of the contract of appointment of a company secretary will specify that he shall ensure compliance with various rules, regulations, sections, acts, and all that stuff, right? So this is about the appointment of company secretary. So now coming to the concepts of compromises, arrangements, and settlements. Again, this for the old syllabus is covered for the CRV under the CRVI, and for the new syllabus it is covered under the restructuring paper, and hence I would not try to bore you with a lot of theory, but I would like to give a broad understanding of how these help in the real life, or rather in the practical scenarios. So now let me give you an example. A Limited is a company which has three businesses. Let us say it is into cement, um, real estate constructions, rather constructions also, right? And it is also into government projects. These are again, of course, infra, but this is purely home houses. But this is laying of roads, buildings, etc. Like it's huge. So now A Limited has got a lot of debt. Lot means lot. So, but it's a lot of debt has been belonging to these two. But it actually wants to save its cement business and try to encash from it. So what it thinks is, let me remove this from my company and try to send it to a new company B Limited where I will hold 100% equity. But this company will run on its own. It will have its own profits and it need not be burdened with the liability which these two businesses get into. Correct? So this sounds good. This sounds practicable, but the only point is how do you do it? How can you simply separate a business from a company and send it to someone? A company is an artificial person, so how can all this happen, right? So isn't that a question you need to ask? And a normal person should not ask this, but as a company secretary, you should ask yourself, how can I do this? And if you see, the transaction is very clear for if someone who knows the basics of M&A. So this is a transaction of a demerger. Is it a demerger alone? The answer is no. It can also be a transaction of a slump sale, that is nothing but a business transfer. Of course, we have a separate slide where we discuss on the slump sale, but yeah, it is a concept of a demerger. So how do you ensure? How do you actually give effect to a demerger? That is where I'm coming back to. So demerger is affected by way of a scheme of arrangement. So demergers, mergers, amalgamations are all under the broad bracket of arrangements. Restructuring, they fall under a restructuring. And then comes the compromises and settlements. So compromises and settlements are usually with creditors, so you tend to settle with the creditors, you tend to compromise with the creditors, or you want the creditors to compromise. So that is a scheme of compromise, and this being a scheme of settlement, or rather the scheme of arrangement. So these schemes of compromises and arrangements are covered under section 230 to 234 of the Companies Act 2013, and it predominantly is a document. So as I called it, it's a scheme. So if suppose in this case, A Limited having off its business to B Limited, the cement business to B Limited, thereby making it a separate entity, is what is a scheme of demerger of the cement business of A Limited into B Limited. So this scheme will cover, so who are the two parties? So in any scheme, there would be transferor and transferee companies and scheme of arrangements. So in this example, the transferor is A Limited, the transferee is B Limited. Correct? And this scheme has affected for a demerger. So what does the scheme cover effectively is to give this transaction. The scheme should cover this transaction per se, right? So this is about a scheme of compromise, arrangements and settlements, and I'll just try to give you a fair idea of how the procedure looks like. So the procedure is like, firstly, there would be board meetings in both the companies, the transferor and transferee. And this in the board meetings, they would approve the respective schemes. And if it is a listed company, then immediately a filing shall be made before the stock exchanges, before you can go with the NCLT. Then the stock exchanges will give an observation letter or a no objection certificate. Then you will file the same with the NCLT. Then the NCLT will convene for a shareholders meeting. And in case where the interest of the creditors is involved, then they will call for a creditors meeting also, which is a class wise meeting. This is very important. In case of schemes of compromises, arrangements and settlements, you need to take approval of the respective classes of the creditors. So each class should give their approvals. So suppose unsecured and unsecured, suppose debenture holders will give their approval. The deposit holders should give their approval. Term loans, bankers should give their approvals. Working capital loans is a separate class. If at all they belong to a separate class, then they give a separate approval. So it is all up to the kind of classes which the company has in terms of the creditors. Every class shall give its approval. Now, NCLT convenes a meeting. So in the meeting of the shareholders, you need to get at least 3/4 of in value to give the approval. And if it is in case of a listed company, it also mandates that not public shareholders should vote in majority. So the ones who out of the public, that is apart from the promoters, the rest of the public shareholders should have voted in favor. The ones who have voted in favor should have been more than the ones who have voted against. So that is again very important. And in the meantime, after the meeting has been convened and the approval has been received, then NCLT will hear the objections from the ROC, from the OL, and also from any party who is objecting. So hence you have to correspond with the OL and the ROC. And then even if it is in the case of a merger or amalgamation, then you need to, if there shall also be a consideration of application to a CCA, that is Competition Commission of India. And finally, after looking into all the objections and also ensuring that everything is in place, the NCLT will pass an order, which is the final order, which shall bind all the parties to the particular scheme, and also to all the consenting parties who would have consented to this. And finally, that order will be filed with the ROC. So this is the entire concept of compromises and arrangements. So if you carefully understand, generally for you to build a company, you build it from the scratch, you insert the capital, you give the capital, then from the capital you buy the raw material, from the raw material you get the finished product. Or if the services, then you rent out a place, or you buy out a place, then you buy out the basic equipment, then people will come, they work on something, and the final output will come, and then you would generate revenues. But in case of schemes, so as the name suggests, so you can take an existing business, you can remove one of your limbs, that is one of the businesses of yours, and separate it into separate entity. So these are certain, you can call like a surgery. So these are certain surgeries which you do to a company. And for you to affect such surgeries, how do you do? It is through the schemes. The scheme will be that document which will cover everything which is possible, or everything which can give effect to what you want as an outcome, right? So now let us look into how the scheme of amalgamation will be. So amalgamation deeds are, as you can see, there would be two companies, A and B. If both the companies merge and form a new company, this is a standard example of an amalgamation. But where A and B merge and only B is in place, that is A is dissolved, then it is amalgamation in the nature of merger. So this is a pure merger, whereas this is a classic example of an amalgamation. And in the industry, you get to find both of these transactions happening, right? So as I have explained again, amalgamation is also a scheme of arrangement. So the procedure remains the same, the concept remains the same. Now let us look into the main aspect, that is what shall such a contract, or rather such a deed, an amalgamation deed, contain. If it will contain the definition of transferor and transferee company. So A Limited is a transferor company, B Limited is a transferee company. Is that right? No. In case of an amalgamation, both A and B are transferor companies. The C, the newly formed company, will become the transferee company. Similarly, in case of the merger, here of course, yeah, since B is the transferee company as well, so A will be the transferor and B will become the transferee company in case of a merger. So now, whatever it is, we have to define who the transferor company is, who the transferee company is, and also the undertaking of the transferor company. That is, what is the kind of property which is being transferred? Give the entire detail, all the assets, all the liabilities, everything. Then what are the capitals both the company has, we have to give. Then the basis of the scheme should be explained. This is very important. A brief explanation has to be given as to the basis of the scheme, the valuation, right? Suppose you're buying out a company for, let us say, some 500 crore. So why 500 crore? How did you end up coming to the figure of 500 crore? It can be by way of a valuation report, then mention the fact that there's a valuation report, and also try to cover how all the transfer of assets and liabilities is being happening, and give the date on which the valuation has been taken place, and all other aspects which you would have led to for the sake of getting permissions and all should be clearly specified in your scheme. Then if you're hinting at a change of name, that should be mentioned. Objects should be mentioned if you want to change the objects post amalgamation. Then also the accounting year, if you want, if there would be a likely change of an accounting year, even that should be clearly mentioned. And then employment part. So are you trying to retrench any employees because of this scheme? Then you should make sure that the same will be mentioned, but usually that won't happen. So it will be written that all the employees will be retained. However, a careful re-scrutiny of the employment capacity will be taken into picture. That is how they carefully draft such clauses. Because usually if you remove the if the clause, if the scheme mentions a clause which says that there would be retrenchment of the employees, then there would be a kind of a friction from the NCLT itself, and usually they don't try to risk doing that. Then we have the dividend portion and prospects. So if any, this is something which is not mandatory, but if any, then the management structure. So how is the management structure, the organization structure of it, and what would be the number of directors the transferee company would have, that can also be mentioned. And what happens with the existing board of the transferor company? Will they be taken into the new board of the transferee company or will they not? Right. So you can at the back of your mind you can think of Idea and Vodafone as to how their merger happened to Vodafone Idea, right? And then yeah, the applications you will make. So you should also clearly state, the scheme itself should clearly mention that this scheme is subject to the approval of the NCLT, approval of the CCI if any required, and all the expenses of amalgamation, who shall bear the expense of amalgamation, right? And then the conditions of the scheme to become effective, right? So what are the basic conditions precedent to for the scheme to become effective, conditions subsequent for the scheme to become effective, and what is the effective date of the amalgamation, what is the appointed date from which the accounting shall change, what would be the accounting which would be applicable to it. So you should rather give, the scheme should say that they would comply with the applicable accounting standards, they would comply with the required shareholder approvals and all these aspects. This would something which will be containing in a scheme, which is a scheme of amalgamation, and this scheme will be the Bible for the rest of the life of the company, right? And hence the scheme has to be very carefully drafted, right? Now finally, the slump sale agreement. So I've just given a very brief intro in the beginning as to how I would have diversified a business. So quickly to a quick recap. So A has got three businesses: cement, housing, and infra, that is road projects and all. So now A wants to remove it and A wants to form a new company to which the cement industry will be taken, and this new company will be anything. It can be 100% subsidiary or whatever. So this I said will be a demerger, classic example of a demerger. However, this can also be possible by way of a slump sale, is what I said. So what is a slump sale? A slump sale is a sale wherein a bunch of assets will be sold by not assigning individual values to the assets. So that is what is a slump sale. So in this case, what's happening? A is entering into a business transfer with B, wherein it is transferring the entire cement business along with its liabilities to B. So that is what is a slump sale in this case, right? So in income tax also there is a definition of slump sale, and hence for you to claim the benefit under the Income Tax Act, you should try to make sure your deal will come within the four walls of the Income Tax Act. Now, uh, as pointed out, they in the basic condition should be that there is a transfer of undertaking and it is not individual assets and liabilities consisting of the business. The entire undertaking, the business per se, should completely be transferred, right? So this is fundamentally the concept of a slump sale. So what are the various steps involved in a slump sale? Firstly, you should find out who the buyer is, right? So who would be the buyer, who would be the prospective buyer, then enter into a term sheet, then make a valuation of the entire business, and then structure the deal, then finally enter into a definitive agreement, which is the slump sale agreement, wherein you clearly define what are all the assets, because you are not selling the entire company A, you are rather selling only one division of A, which is a cement business. Hence you have to be extra cautious in specifying what are all the assets, specifying what are all the liabilities individually, which will get transferred, assets along with the locations where they are situated, and what are the extent to which it will be sold. Everything has to be clear cut and very properly documented, because that would define the future of B Limited and the claims of B Limited, and hence it is a proper business transfer which would be proposed, right? So this is the concept of a slump sale agreement. With this, we finish this lesson. Thank you so much. So thanks for watching the video. If you wish to learn more on how to draft or you want to practice various exercises to sharpen your drafting skills for your examination and also for your practice as a trainee or as a company secretary, please fill in the information in the form which is provided in the description below. We are coming out with a course very soon. Thank you. Stay tuned to Virtualaw, and this is Prakul signing off from VL Academy.